when I travel around, CEOs of other industries, logistics, steel, manufacturing, pipeline, they've all seen it. Have we seen actual changes in regulation for us? Not really. They have a long list of things they want to do. There has been regulatory change for the smaller banks, which we totally support, to make it a little bit easier for them, reduce the burden on them, but it didn't have anything to do for the bigger banks. I think, and the public should know, we're not asking for throwing out Dodd-Frank. People simply look at calibrating, getting rid of duplication, looking at things that hurt the mortgage markets, hurt this kind of market, so you can enhance growth and do it safely. No one's looking at, going back to good old days, just recalibrating. Remember, there were 2,000 rules. It wasn't like one or two, it was a lot, and they were done in haste. And people should always rationally look at cost benefit, what makes sense, what doesn't, all keeping the system safer. And remember, growth, a stronger economy, it also makes the financial system safer.
Now, you just mentioned no rate potholes. We've got a Fed meeting that's coming up this week. The spread that you would get 2 and 10, to use the typical logic that people say, means that you can't make as much money and therefore you can't lend as much.
Yeah. So when I say the no potholes, the household's in good shape, people going back to work,
FICO scores
in good shape,
high.
FICO scores are fine, companies are flush, tax reform is still a benefit. We don't have the extreme leverage we had in 2008, and all the lending has been pretty good, prime, good lending, so it's not been bad lending. But absolutely, there's friction out there, and there's always friction. If you open up a newspaper any week of any month, there's tons of friction, and it's mounting. Brexit, QE, Turkey, Argentina, and we don't know the full effect of those things. So yeah, we keep our eye on that, but it may not derail the economy. You got to separate the two.
I keep thinking these are all things that should play to your fortress balance sheet strength. We got European banks that are really on the run, so to speak. Why isn't JP Morgan making greater presence given the weakness of the rest of the world?
Yeah. Well, we do. We're in every country we're in. We're steady, growing, and we do country by country, adding more bankers, systems, people, and all the support, risk, legal, credit, compliance. So our share in Europe has gone up considerably. And we're just doing it by adding people and adding branches and, the basic good old 3 yards in a cloud of dust.
Well, okay, when I hear 3 yards in a cloud of dust, I think you should get a higher priced earnings multiple, for heaven's sake. You're selling at 12 times next year's earnings. We've been at this game for a long time. If for your growth financial with money that's made every single day you open the door, why aren't you valued like a typical S&P company?
That's a question you're going to have to answer. Banks are still under political, regulatory constraints and all that. We just went through the crisis, so I think a lot of people as investors probably always a little worried. But you're right, we're earning very good returns in capital. We're growing. When a cycle hits, obviously it's going to affect the bank, but we will manage right through that cycle, just like we did right through the last one.